Buying a property is a significant milestone, but millennials often stumble over the same hurdles. Let's uncover these common mistakes. One of the most frequent blunders is making large purchases that up your monthly payments, thus shrinking the affordability of your potential mortgage. Just imagine, for every $100 of debt you take on each month, your home mortgage affordability goes down by a whopping $100,000. That's why it's so crucial to plan carefully and strategically when you're on the journey to becoming a homeowner. Now, you might be thinking, I need a new car, or I could really use a new credit card to help with these expenses. But let me tell you, taking on these debts could be the very thing that keeps you from unlocking the door to your new home. What's more, it's not uncommon for people to help out a relative or friend by co-signing a loan. But remember, if you're planning to buy a property, this could jeopardize your chances. The loan officer doesn't care if you're just the co-signer. They see it as your debt. Another common pitfall is underestimating the importance of job stability. Some lenders require you to have been a W-2 employee for a year for a traditional loan. And if you're working part-time, regardless of your income level, you'll need to have 2 years of employment under your belt before you can be considered for a home loan. And let's not forget about the source of your down payment. It needs to be from your income or a gift, not borrowed. Banks will scrutinize any funds deposited within 60 days, and sometimes even beyond that. They want to make sure the funds are genuinely yours, not a debt in disguise. Lastly, it's essential to shop around for the best mortgage deal. Get pre-qualified from at least 3 banks, and then choose the one that offers the best interest rate, affordability, and timely loan closing. Remember, it's not about how much you can borrow, it's about how much you can comfortably afford. When it comes to property buying, your credit score and debt utilization carry a lot of weight. Imagine your credit score as a report card for your financial health. It's a 3-digit number that tells lenders how reliable you are when it comes to paying back your debts. A high credit score can unlock doors to lower interest rates and more favorable loan terms. On the other hand, a low credit score can make it harder for you to secure a mortgage, or if you do get one, you might end up paying more in interest over the life of the loan. Now, let's talk about debt utilization, or rather your debt to income ratio, commonly known as DTI. This is the percentage of your monthly gross income that goes towards paying your debts. Mortgage lenders often use this ratio to assess your ability to manage the payments you make every month to repay the money you have borrowed. In general, a lower DTI can make you look more attractive to lenders. When planning to buy a property, it's crucial to maintain a DTI below 43%. This is the threshold set by most mortgage lenders. Crossing it might make them think twice about lending to you. So before you take that shiny new car on credit or co-sign a loan for a friend, remember that it could affect your DTI and your chances of securing a mortgage. However, it's not all doom and gloom. There are ways to improve your credit score and DTI. Start by paying all your bills on time, reducing the amount of debt you owe, and avoiding new debt. It's like training for a marathon. It takes time and consistent effort, but the result is worth it. A healthier financial profile that makes lenders more likely to say yes to your mortgage application. In conclusion, your credit score and DTI are not just numbers. They are your key to a successful property purchase. They reflect your financial habits and reliability, and they can open or close doors for you in the property market. So, nurture them, keep them in good shape, and they will serve you well. Your credit score and DTI are not just numbers, they're your ticket to a successful property purchase. In the property buying process, your employment status and history play a critical role. This is because your job is, for most people, the primary source of income used to pay off the mortgage. But it's not just about having a job, it's about having a stable job. This stability is often measured in years and not in months. Some lenders, especially those offering traditional loans, require you to be a W-2 employee for at least a year. This requirement arises from the perceived reliability associated with being a W-2 employee. You have a steady income, you're less likely to suddenly lose your job, and you're generally seen as a safer bet. However, don't worry if you're not a W-2 employee. If you're part-time or self-employed, you can still get a home loan. But there's a catch. You need to show 2 years of work history. Why 2 years? It's because these types of employment are seen as less stable. By showing 2 years of consistent work, you're demonstrating that you're able to maintain a steady income despite potential fluctuations in your job situation. Self-employment income or income from being a 1099 employee is also considered. But again, there's a 2-year requirement. This requirement is there because the loan officer will average your income over the last 2 years to assess your mortgage affordability. So, what's the takeaway here? If you are planning to buy a property, you need to consider your employment situation. Are you a W-2 employee, part-time, or self-employed? Have you been consistently employed for the past year or two? If not, you might need to think about making some changes to increase your chances of getting a home loan. Remember, stable employment is not just about earning a paycheck. It's about building your credibility as a potential home owner. It's about showing lenders that you're reliable, responsible, and ready to take on the commitment of a mortgage. So before you start house hunting, take a good hard look at your employment situation. It could make all the difference when it comes to getting your dream home. The source of your down payment can make or break your property buying journey. Picture this scenario. You found your dream home and you're ready to take the plunge. You've got your eyes set on the prize, and all you need now is that golden key, the down payment. Now, where does this down payment come from? It could be from your hard-earned savings, a generous gift from friends or family, or perhaps an inheritance. Whatever the source, it has to be legitimate. And here's why. Banks are like Sherlock Holmes when it comes to scrutinizing the source of your down payment. They'll peer through their magnifying glass at your financial history, tracing back every dollar. If you've received a large sum of money recently, they'll want to know where it came from. If it's a loan or credit card funds, that could raise a red flag. Why, you ask? Well, borrowing funds to make a down payment essentially means you're taking on more debt. And more debt means a higher risk for the bank. Plus, it could affect your debt-to-income ratio, which we've already established as a crucial factor in getting a mortgage. On the other hand, if your down payment comes from personal savings, it shows financial discipline and planning. It's a thumbs up from the bank, signaling that you're a safe bet. A gift from family or friends is also generally acceptable as long as it's properly documented and not a disguised loan. So, as you embark on this property buying journey, remember that your down payment isn't just a number. It's a story that reflects your financial habits and reliability. It can be the difference between unlocking the door to your dream home or watching it slip through your fingers. And when it comes to this story, you are the author. You have the power to shape it through your financial decisions. So, make wise choices, plan ahead, and show the banks that you're a worthy investment.